Hi, welcome back to Introduction to Real Estate Finance. This is Chapter 1B, where we're going to cover capital and financial markets. Okay, so what do we mean by capital and capitalization? To start off with, capital is defined to be, for an entity, cash raised by the entity to establish, purchase, or expand its business. And this does not mean cash used for day-to-day operations, such as for paying suppliers, etc. What do folks mean by sources of capital? A source of capital is really anything or anyone the entity can find to provide the cash. Typical sources are debt sources, which folks in finance will call debt capital. That includes primarily taking out loans or issuing bonds. Also, we have equity sources, which again, folks will call, folks from the finance arena, equity capital. And that means issuing shares of stock. The entity issues shares of stock, which are certificates of ownership, and in return, they get cash from those folks who are joining the I own part of this entity club. Another equity source is retained earnings, and that would be net income. Net income is revenue, day-to-day cash coming in from sales of products or services, minus expenses, which are day-to-day expenditures required to make the day-to-day revenue happen. So net income minus dividends. Dividends are payments made back to owners of the firm. These are not in any way required, but a lot of firms do make them. So in the case of retained earnings as an equity source of capital, a firm might say something like, we raise capital organically through our operations. And when they say that, they mean internally. Organically really means internally when they say that. Okay, so what do we mean by capitalization? Capitalization is just simply a description of the forms or sources of capital that an entity has used. And we can think of this in a couple of different ways. In accrual accounting terms, we can think of this equation, which is just a minor expansion of the fundamental assets equal liabilities plus equity equation in accounting. So we could say assets, according to generally agreed upon accounting principles, is equal to the firm's operating liabilities. That's stuff it has to pay from its day-to-day operations, invoices it has for supplies it's gotten, et cetera, electric bills, stuff like that, plus debt liabilities. So those would be liabilities from raising capital, issuing bonds or taking out loans, plus equity on a GAAP basis. Okay, we can also think of this in terms of market value accounting. We could say that an entity's assets in market value terms are equal to its operating liabilities marked at market values, plus its debt liabilities marked at market values, plus its equity at market value. We'll look at an example of both of these in just a second, which will make this a little more clear. In either case, however, we say that a firm is capitalized by its debt and its equity, not its operating liabilities. Again, the operating liabilities are commitments to pay cash in the future related to its day-to-day operations. So things like electric bills, paying for gasoline, paying for heating oil in their buildings, that sort of stuff. Okay. Also, quick note that liabilities as measured by financial accounting are usually exactly the same as liabilities as we would measure at market value. So now let's look at an example, which I think should make these things a little more clear. So let's look at Apple Corporation as of 9/30, 2013. If we looked at its accounting financial statements, we would see that its debt was 17 billion. We would find that on its balance sheet. Its GAAP equity, its accounting equity, which is not really market value of equity, was equal to at the time 124 billion. And we add those two up and we'd say that is the firm's capitalization on a financial accounting or GAAP basis. So that would be 141 billion. So the firm's capitalization was made up of about 92% equity and about 8% debt. All right, now we could do the same thing on a market value basis. So the market value of the firm's debt at the same time was 16 billion. How did we get this 16 billion number? Well, we went to Bloomberg or Yahoo Finance or Google Finance and we looked up all of Apple's debt, and Apple's only debt, essentially its only debt was one bond that the firm had issued. So we took all the bonds it had issued times the price per bond, and we got 16 billion. So that was close to what was shown on their financial reports, which is the value of these when the bonds were issued, but not exactly the same. And that's, as we know, because bonds are transferable contract whose prices fluctuate a little bit in the marketplace, but very, very similar numbers here. Now, the equity market value for Apple at the time was 480 billion. So how did we find that? The 480 billion was found simply by looking up the number of shares of stock Apple had outstanding and the price per share for each share of stock. Both of those things available, Yahoo Finance, Google Finance, Bloomberg, etc. So the number of shares outstanding times the price per share equaled 480 billion. And notice how this is very, very different than the equity shown on the financial statements. Equity on financial statements is simply just total assets shown on the financial statements, which are measured at cost, minus liabilities. So it's really just an arithmetic construct. Down here, this value of equity has more meaning because if you bought every share of the firm for today's price per share, you would own 100% of the firm. So this is telling us that if you wanted to buy Apple, you'd have to pay $480 billion. This is just simply telling us assets at cost minus liabilities at cost equals 124 billion. It's not nearly as good information as what we're getting down here. So total capitalization, market value, 496 billion. Almost all of that was comprised of equity capital, 97% equity capital, and 3% debt capital. Okay, so now let's talk a little bit about financial markets. So financial markets can be one of two things. First, where firms, except for very small startups, go to raise debt and equity capital. These are called primary markets, where the firms actually go to get money. But financial markets also mean something different. They also mean where debt contracts, equity certificates, and related securities can be traded. Those are secondary markets, okay? Firms who are looking to raise capital may or may not be involved. So in other words, a firm that's looking to issue shares of stock to get cash for that would issue in the primary market. So let's say they sold to me 100 shares of stock directly, and then the firm would get the money from that 100 shares of stock. And then a year later, I decide that I've just got to go off to Belize, so I want to sell those shares of stock. I sell them to you, okay? That's what we call a secondary market. The company who issued the stock essentially has nothing to do with that trade. Okay, that's almost always true. Sometimes company can buy back its stock in the secondary market, but usually secondary market trades are by third parties that have nothing to do with the entity itself. And financial markets are always implicitly evaluating a business's financial performance through the share price for the firm's equity and the price per bond, for example, of the firm's bond and other types of debt. Startups are usually too small for their debt and equity to be traded easily, so that's why you don't see their debt and equity in financial markets. For startups, how do startups generate capital? They go to family and friends, crowdsource funders like Kickstarter, Crowdfunder, Fundrise, angel investors, venture capitalists. All right, now we have an understanding of financial markets. So what do we mean by capital markets? Okay, capital markets are a subset of financial markets. They're markets for issuing and trading debt and equity securities only. Okay, so loans, for example, are not securities. Loans happen in primary financial debt markets, and they can actually be traded in secondary markets, but they're not securities, so they're not part of capital markets. Okay, equity capital. Equity capital happens when entities raise this by selling shares of stock, and that would be in a primary equity market. So key features of equity capital are that each share of stock is an ownership interest in a company. It's not a contract promising that the company will do anything for the owner, just declares that the owner owns a portion of the company. So for example, if Smallco has issued 100 shares of stock, we'd say it has 100 shares outstanding. If you owned one share, you'd own 100% of the company. If you owned 100 shares, you would own the entire firm. Okay, as I've said several times before, stock shares are not contracts. They come with no promise or guarantee of anything. So who is a stock investor? A stock investor is someone who purchases shares with the hope of price appreciation of those shares and or receiving dividends, neither one of which is guaranteed or promised in any way. If a company goes bankrupt, stockholders get compensated less, and they almost always get nothing because bankrupt companies typically have more liabilities in bonds and loans than they have in assets they can sell off to pay off those bonds and loans. So what happens is the debt investors in a company don't get paid off fully, but because stock investors get paid after debt investors, there is usually nothing left for stock investors. What are some key features of equity markets? They're pretty big. Total capitalization of all the firms in the NYSE, about 21 trillion. And there's a lot of trading volume of shares, about 6 billion shares a day, representing about $80 billion on the New York Stock Exchange. And there's a lot of issuance. That would be primary market issuance in what's called initial public offerings or IPOs, and also secondary public offerings. So about $50 billion a year. Um, Entities don't have to list on an exchange. You can create an entity, excuse me, an LLC or a C Corp or a REIT and sell shares directly to friends, venture capitalists, etc. If your shares of stock are not traded on an exchange, your equity is said to be privately held. An initial public offering represents the first time a company issues shares on an exchange, and a secondary offering is offered for by a company that's already listed on something like the NYSE, and they're just offering more shares through the exchange. Um, Entities only raise capital when they are issuing their shares. The other marketplace trades, as I pointed out previously, have nothing to do with the issuing entity. The marketplace trades that happen after shares are issued are in the secondary market, as I've alluded to before. However, issuing entities can repurchase or buy back their shares of stock in the secondary market. Firms do this a lot because they like to do this. Some firms like to do this instead of issuing dividends because let's say they have a $1 million in net income and they have 1 million shares in the market. So all of the owners have an earnings per share price of $1 a share. And if they cut that in two, if they buy back 500,000 shares and they still have $1 million in net income, their earnings per share jumps up to $2 per share. So firms like to do that sometimes. So for those of you who've had accounting, in accounting terms, that transaction for doing that would look something like this. The firm would say debit paid in capital, that reduces their paid in capital here, or minus paid in capital. On the other side, they would have to be paying out cash to a broker in the secondary market to buy their own shares back. So CR cash or minus cash here. Okay, what are some equity trading platforms? I've mentioned already the NASDAQ and the NYSE. There's also interesting one is OTC Link. Excuse me, sanctioned by the SEC, and it's run by a firm called OTC Markets, and it has no listing requirements. That's kind of interesting. So if you started a C Corp tomorrow, you could go and list your firm on OTC Link, which is pretty interesting. Okay, debt capital, we talked about this a little before. Let's just make sure we're all on the same page. So debt capital comes from taking out loans or selling bonds, and that of course is going to be in a primary market. Okay, key things to know about debt. Unlike equity, debt is always a contract. It always features an entity getting some cash now with a promise to repay it later and probably paying interest or rent along the way, right? What are interest payments? They're really just paying rent for the cash that someone has given you for a certain period of time. Most debt contracts are structured such that if the company can't make a payment, an interest payment or a repayment of principal, the lender essentially has the right to take over the company immediately. Good way to remember this, the way I remember it, is think of defaulting on a mortgage. If you default on a mortgage, the bank has the right to take the property away from you. So what happens is companies who feel like they're about to be in that boat, they'll run to a judge to get in what's called Chapter 11 bankruptcy protection, and they'll say, we're about to be in big trouble, we can't repay some of our debt, our lender is going to take over the company. Please protect us and buy us some time to rework our agreements with our creditors. Okay, the two main types of debts, like we said, are loans, contract made directly with one or more lenders. They're not securities, but they can still be traded. Bonds are inherently marketable securities issued by the borrower, and bonds are transferable contracts, so they can be bought and sold at will. Secured debt is a debt for which specific collateral exists. That's very important in real estate, many types of real estate finance. A mortgage, for example, is a secured debt instrument. The property in a mortgage is used as collateral. And great thing about secured debt is if the issuer of the debt defaults, the lender gets the collateral. So if you default on your mortgage, the bank gets your home, for example. Unsecured debt is a very, very common source of debt generally in finance. It's debt for which no specific individual piece of collateral exists. Unsecured debt is implicitly secured against all the borrowing entity's assets. So if there's a default, again, the lender would take over the entity or go to court for redress, and the borrower will try to preemptively head off this by filing for Chapter 11 bankruptcy protection. Um, the Here's a very simple example. A loan contract could say something like, if one interest payment is missed by 1 nanosecond, the entity agrees to immediately pass 100% of its ownership to the lender. Okay, a little bit of terminology frequently used in the real estate industry. Mortgage debt. Mortgage debt is clearly a type of secured debt, and the securing is done against the real property. Mezz debt or mezzanine debt is a type of unsecured debt, and it's really just secured against an ownership stake in the entity, not the property itself. Okay, bond markets, like equity markets, are big, and you can see there are a lot of different types of bonds. Treasury bonds, that's US government, corporate debt, mortgage-related bonds, municipal entities, government entities, et cetera, et cetera, et cetera. 822 billion average trading volume, about 10 times what we saw in the equity markets, about 4 trillion in annual issuance, and the what we saw with the equity markets here was market capitalization of 21 trillion, and what we see here for when we total up everything in the bond markets, we get almost 39 trillion, so significantly bigger than what's there in the equity markets. Okay, with bond issuance, the entity sells bonds to investors in the primary market, and then when investors buy and sell those bonds among each other, that's called a secondary market trade. And just like with stocks, entities may repurchase their bonds in the secondary market, and the entities only get money in the primary market when they issue bonds. Some example bond trading platforms are Bond Desk, run by TradeWeb, designed for retail investors, Bond Point, run by Ignite for retail investors, market access, maybe the most important one for institutional investors. Notice that for equities, let me just jump back here for a second. Oh, yeah, here we go. When we're looking at equity trading platforms, they all are sanctioned by the Securities and Exchange Commission. And that's not true with bond trading platforms. They're all just set up by individual for-profit entities. Okay, derivatives. Just a little bit on derivatives. What is a derivative? It's a financial contract that is valued by the performance of another security, asset, or index, which is called the underlying. Key features are if it's based on a security, it may or may not be issued by the underlying entity. So options and futures and things like that don't have to be, if you're Microsoft, the options on Microsoft share price of stock, for example, does not have to be issued by Microsoft. You could issue an option on Microsoft stock if you wanted to. Derivatives also in general may or may not provide an economic value to the underlying entity. If you went into the business of issuing and trading your own proprietary options on Microsoft, that would really have nothing to do with Microsoft's cash inflows, outflows, or microeconomics. And derivatives are used for insurance, options are used for insurance, hedging, futures are used for hedging, and speculation. Common types of derivatives, futures and forward contracts. These are obligations to purchase a security at a future time at a certain price. A futures contract is traded on an exchange, and a forward contract is made directly between two parties. Okay, so here's just a quick example of use of a futures contract for hedging. And what do we mean by hedging? That means reducing financial risk by reducing uncertainty of future prices. So let's say, for example, in September, a heating oil company buys a futures contract as follows. This would be an obligation to purchase 100,000 gallons of heating oil on January 1 for $33 a gallon. Why would they want to do something like that? Well, here is a 12-month price of heating oil in the marketplace, and you can see it's very, very volatile. So if they want to plan ahead with some certainty, they'll say, okay, we may win, we may lose, but if we go into this contract, we know for sure we're going to pay $33 a gallon. That gives us certainty. That makes it easier for us to plan financially for our future. Okay, options and futures are probably the two most important things we should know a little bit about. Options are the right but not the obligation to buy or sell a security in the future at a certain price. Call option is the right to buy in the future. Put option is the right to sell. And puts and calls can be bought or sold, so that gives us a total of 4 possibilities. So I think I'm going to defer the rest of our discussion on options till a little later in the course. If you're interested right now, you're really dying to suss this all out right now, you're welcome to look through this example, which is pretty straightforward. You're also welcome to read about this subject in the Introduction to Finance textbook. But we don't need this information urgently right now. So as I say, I think I'm going to defer its discussion a little bit to a little bit later in the course. And I think, honestly, this is all we really need to cover in this outline chapter right now. So let me just type in here that we don't need Uh, Anything else? And let's call it a project for this outline chapter. See you in the next chapter.